Introduction to real estate investing. Real estate investing involves the purchase, ownership, management, rental, and/or sale of real estate for profit. It is a popular investment avenue due to its potential for capital appreciation, rental income, and portfolio diversification. Unlike other asset classes, real estate often provides tangible assets that can be leveraged and improved over time. Understanding the fundamentals is crucial before delving into specific strategies and market dynamics. This course will lay the groundwork for a successful journey in real estate investment. It covers essential terminology and the various benefits and challenges associated with this asset class. Investors often seek real estate for long-term wealth creation and passive income streams. The appeal of real estate investment stems from several factors, including its ability to act as a hedge against inflation. Property values and rental income often increase with inflation, preserving purchasing power. Additionally, real estate offers tax advantages, such as depreciation deductions and potential for tax-deferred exchanges. It also provides a sense of control, as investors can actively manage and improve their properties to increase value. This hands-on approach distinguishes it from more passive investments like stocks or bonds. However, it also requires significant capital and a thorough understanding of market risks. Types of real estate investments. Real estate investments encompass a broad spectrum of property types, each with unique characteristics and investment profiles. Residential properties, such as single-family homes, multi-family units, and apartments, are often favored for their consistent rental income and relatively stable demand. Commercial properties include office buildings, retail spaces, and industrial warehouses, typically requiring larger capital outlays but offering higher potential returns. Specialized properties like hotels, self-storage facilities, and healthcare facilities present niche opportunities with distinct operational considerations. Understanding these categories helps investors align their strategies with their risk tolerance and financial goals. Each type has its own market dynamics and management requirements. Diversification across different property types can mitigate risk. Investors can also choose between direct and indirect real estate investments. Direct investment involves purchasing and managing physical properties, offering greater control but demanding more time and expertise. Indirect investments, such as real estate investment trusts, REITs, or real estate crowdfunding platforms, allow investors to gain exposure to real estate without direct ownership and management responsibilities. These options provide liquidity and diversification benefits, making them accessible to a wider range of investors. Each approach has its own advantages and disadvantages regarding capital commitment, management involvement, and potential returns. Evaluating these options is key to building a balanced portfolio. Understanding real estate markets. Real estate markets are complex and influenced by a multitude of economic, social, and political factors. Key drivers include population growth, employment rates, interest rates, and government policies. A growing population typically increases demand for housing and commercial spaces, leading to higher property values and rents. Strong employment figures indicate a healthy economy, encouraging business expansion and consumer spending, which in turn boosts real estate activity. Conversely, rising interest rates can make borrowing more expensive, dampening buyer demand and slowing market growth. Government regulations, zoning laws, and infrastructure projects also significantly shape market conditions. Analyzing these factors is essential for making informed investment decisions and predicting future market performance. Local market analysis is particularly critical, as real estate is inherently a localized asset. What thrives in one city might struggle in another due to differing economic bases, demographics, and local regulations. Investors must research local job growth, median income levels, vacancy rates, and new construction permits. Understanding the supply and demand dynamics within a specific submarket can reveal lucrative opportunities or potential pitfalls. For example, an area with limited new construction and increasing population might experience rapid appreciation. Conversely, oversupply can lead to declining rents and property values. Thorough local market research provides a competitive edge. Market cycles and trends. Real estate markets do not move in a straight line. They typically follow cyclical patterns characterized by periods of expansion, peak, contraction, and trough. Understanding these cycles is paramount for timing investments and maximizing returns. During expansion, demand outpaces supply, leading to rising prices and new construction. The peak sees prices stabilize or even decline as supply catches up or exceeds demand. Contraction is marked by falling prices, increasing vacancies, and reduced construction activity. Finally, the trough represents the bottom of the market, where prices are low and demand begins to pick up, signaling the start of a new expansion. Identifying an asset's position within its cycle is a critical skill for investors. Several factors can influence the duration and intensity of these cycles, including economic recessions, changes in monetary policy, and shifts in demographic trends. For instance, a sudden economic downturn can accelerate a market into contraction, while sustained low interest rates can prolong an expansion phase. Technological advancements, such as remote work capabilities, can also create new trends, impacting demand for office spaces versus residential properties. Investors must continuously monitor these broader economic indicators and local market specifics to adapt their strategies. Recognizing emerging trends, like the demand for sustainable properties or mixed-use developments, can provide a significant competitive advantage. Staying informed about these macro and micro trends is vital for long-term success. Property valuation methods. Accurate property valuation is fundamental to successful real estate investment, ensuring investors do not overpay for an asset. Several widely accepted methods are used to determine a property's fair market value. The sales comparison approach, SCA, involves analyzing recent sales of comparable properties in the same area, adjusting for differences in features, size, and condition. This method is particularly effective for residential properties, where many similar transactions occur. It relies heavily on the availability of reliable market data and the expertise of the appraiser to make appropriate adjustments. Understanding the nuances of comparable sales is crucial for an accurate assessment. This approach provides a market-driven estimate of value. The income capitalization approach is primarily used for income-generating properties, such as commercial buildings or rental units. This method estimates a property's value based on its potential to generate future income. It involves calculating the net operating income, NOI, and then dividing it by a capitalization rate, cap rate, which reflects the expected rate of return on the investment. The cost approach, often used for new construction or unique properties where comparable sales are scarce, estimates value by calculating the cost to replace the property new, minus depreciation, plus the value of the land. Each method provides a different perspective on value, and often a combination of approaches is used for a comprehensive valuation. Financial analysis in real estate. Conducting thorough financial analysis is paramount for evaluating the profitability and viability of any real estate investment. Key metrics and ratios help investors assess potential returns and risks. Net operating income, NOI, is a crucial measure, representing a property's annual income after deducting all operating expenses but before debt service and taxes. Cash-on-cash return calculates the annual pre-tax cash flow divided by the total cash invested, providing a clear picture of the actual return on equity. Capitalization rate, cap rate, is another essential metric, indicating the rate of return on a real estate investment property based on the income that the property is expected to generate. These metrics are vital for comparing different investment opportunities and making informed decisions. Further analytical tools include the internal rate of return, IRR, and net present value, NPV, which consider the time value of money, making them suitable for long-term investment analysis. IRR is the discount rate that makes the NPV of all cash flows from a particular project equal to zero, indicating the project's profitability. NPV measures the difference between the present value of cash inflows and the present value of cash outflows over a period, helping to determine if an investment is worthwhile. Understanding debt service coverage ratio, DSCR, is also critical, especially when financing a property, as it assesses the property's ability to cover its mortgage payments. Proficiency in these financial tools allows investors to accurately project profitability and manage risk effectively. Leverage and debt financing. Leverage in real estate refers to the use of borrowed capital, debt, to increase the potential return of an investment. It allows investors to control a larger asset with a smaller amount of their own money, amplifying both gains and losses. Common forms of debt financing include traditional mortgages, commercial loans, and private loans. Mortgages are typically long-term loans secured by the property itself, offering relatively low interest rates. Commercial loans are often used for larger income-producing properties and may have more flexible terms. Private loans, from individuals or non-institutional lenders, can provide quick access to capital, but often come with higher interest rates. Understanding the various financing options is crucial for optimizing investment strategies and managing risk. While leverage can significantly boost returns, it also introduces substantial risk. A highly leveraged property means higher debt service payments, which can become burdensome if rental income or property values decline. Interest rates play a critical role. Rising rates increase borrowing costs, impacting profitability. Investors must carefully assess their debt-to-equity ratio and ensure sufficient cash flow to cover all expenses, including mortgage payments. A common metric, the debt service coverage ratio, DSCR, helps evaluate a property's ability to cover its debt obligations. Prudent use of leverage involves balancing potential returns with the inherent risks. Over-leveraging can lead to financial distress, especially during market downturns, making careful planning essential. Equity financing and partnerships. Equity financing involves raising capital by selling ownership stakes in a real estate project or property. This method is particularly attractive for larger projects that require significant capital beyond what debt financing alone can provide. Common forms of equity financing include bringing in individual investors, forming joint ventures, or utilizing crowdfunding platforms. Individual investors, often high-net-worth individuals, contribute capital in exchange for a share of the profits and ownership. Joint ventures involve two or more parties pooling resources and expertise for a specific project, sharing both risks and rewards. Crowdfunding allows many small investors to contribute capital, democratizing access to real estate investments. Each approach offers distinct advantages for both the project sponsor and the equity partners. Partnerships and joint ventures can offer numerous benefits beyond just capital. They allow investors to combine diverse expertise, share the workload, and mitigate individual risk. For example, one partner might bring construction experience, while another contributes market analysis skills or access to a network of lenders. However, establishing clear agreements, defining roles, and outlining profit-sharing mechanisms are crucial for successful partnerships. Potential drawbacks include disputes over decision-making, conflicts of interest, and the dilution of individual control. Careful selection of partners and comprehensive legal documentation are essential to ensure alignment of interests and a smooth operational process. Effective communication and a shared vision are the cornerstones of successful equity-based collaborations. Legal aspects of real estate. Navigating the legal landscape of real estate is critical for protecting investments and ensuring compliance. Real estate transactions involve a complex web of laws and regulations that vary significantly by jurisdiction. Key legal aspects include property ownership structures, such as sole ownership, joint tenancy, or tenancy in common, each with different implications for rights and responsibilities. Contracts, including purchase agreements, leases, and financing documents, must be meticulously drafted and reviewed to avoid future disputes. Understanding zoning laws and land use regulations is also paramount, as they dictate what can be built on a property and how it can be used. Ignorance of these laws can lead to costly delays or even project termination. Engaging legal counsel is often indispensable for complex transactions. Environmental regulations, property taxes, and landlord-tenant laws further add to the legal complexities. Environmental assessments are often required to identify potential contamination or hazardous materials, which can significantly impact a property's value and liability. Property taxes are a recurring expense that varies by location and property type, requiring careful budgeting. Landlord-tenant laws govern the rights and responsibilities of both parties in a rental agreement, covering aspects like eviction procedures, security deposits, and maintenance obligations. Adherence to these laws is essential for smooth operations and avoiding legal challenges. Due diligence must always include a thorough review of all relevant legal documentation and potential liabilities to ensure a secure investment. Due diligence process. The due diligence process is a critical investigative period undertaken by a prospective buyer to assess the risks and potential of a real estate investment before finalizing a purchase. This comprehensive examination covers various aspects, including financial, legal, physical, and environmental considerations. Financially, investors scrutinize income and expense statements, rent rolls, and lease agreements to verify cash flow projections. Legally, a thorough review of title reports, zoning compliance, and existing contracts is essential to uncover any encumbrances or restrictions. The goal is to identify any red flags or hidden liabilities that could negatively impact the investment. This meticulous investigation helps validate assumptions and mitigate unforeseen problems. Physically, due diligence involves property inspections to assess the structural integrity, condition of systems, HVAC, plumbing, electrical, and potential repair costs. Environmental assessments, such as Phase 1 and Phase 2 reports, identify any hazardous materials or contamination risks. Market due diligence involves verifying market rents, vacancy rates, and comparable sales to ensure the property's valuation is accurate. This exhaustive process requires coordination with various professionals, including attorneys, accountants, appraisers, and inspectors. A well-executed due diligence process provides the investor with a clear understanding of the asset, enabling them to make an informed decision and negotiate favorable terms. Skipping or rushing this step can lead to significant financial losses and legal complications down the line. Acquisition strategies. Real estate acquisition strategies vary widely depending on an investor's goals, risk tolerance, and available capital. One common approach is buy and hold, where investors purchase properties with the intention of holding them long-term to generate rental income and benefit from capital appreciation. This strategy often involves identifying properties in growing markets with strong rental demand. Another popular strategy is fix and flip, where investors purchase undervalued properties, renovate them, and then quickly sell them for a profit. This approach requires expertise in renovation, market timing, and accurate cost estimation. Both strategies demand a deep understanding of market conditions and property potential. Choosing the right strategy is crucial for aligning with individual investment objectives. Other acquisition strategies include wholesaling, where an investor contracts to buy a property and then assigns the contract to another buyer for a fee without ever taking ownership. This method requires strong networking and negotiation skills. Buy, rehab, rent, refinance, repeat is a strategy that involves purchasing a property, renovating it, renting it out, refinancing to pull out equity, and then using that capital for the next investment. This allows investors to scale their portfolio rapidly. Each strategy has its own set of advantages and disadvantages, requiring different levels of capital, time commitment, and risk exposure. Investors often combine or adapt these strategies to suit specific market opportunities and personal circumstances, emphasizing flexibility and adaptability. Property management fundamentals. Effective property management is crucial for maximizing returns and preserving the value of real estate investments, especially for rental properties. It encompasses a wide range of responsibilities, including tenant acquisition and retention, rent collection, maintenance, and financial reporting. Finding reliable tenants involves thorough screening processes, including background checks and credit assessments. To minimize vacancies and ensure consistent income, maintaining positive tenant relationships is key to reducing turnover and fostering a stable rental environment. Property managers act as the primary point of contact for tenants, addressing concerns and ensuring lease compliance. This role is essential for the day-to-day operations of an income-generating property. Maintenance and repairs are ongoing aspects of property management, requiring prompt attention to preserve asset value and tenant satisfaction. This includes routine inspections, preventative maintenance, and emergency repairs. Financial management involves budgeting, tracking income and expenses, and preparing regular financial statements for investors. Compliance with local, state, and federal housing laws, including fair housing regulations and safety codes, is also a critical responsibility. Investors can choose to self-manage their properties or hire professional property management companies. While self-management offers more control and cost savings, professional managers bring expertise, efficiency, and a buffer between landlords and tenants, making them a valuable asset for larger portfolios or busy investors. The decision depends on the investor's time, experience, and property scale. Residential real estate investing. Residential real estate investing focuses on properties designed for living, such as single-family homes, duplexes, condominiums, and apartment buildings. This sector is often considered a good entry point for new investors due to its relative simplicity and consistent demand for housing. Key advantages include steady rental income, potential for long-term appreciation, and tax benefits. Single-family homes appeal to families seeking stability, while multi-family units offer economies of scale in management and higher cash flow potential. Understanding local demographics, school districts, and neighborhood amenities is crucial for identifying desirable residential investment opportunities. The stability of residential demand often makes it a resilient asset class, even during economic fluctuations. Challenges in residential investing include tenant management, property maintenance, and market fluctuations. Tenant turnover can lead to vacancies and lost income, while unexpected repairs can significantly impact profitability. Compliance with landlord-tenant laws and fair housing regulations is also essential. Strategies for residential investing often include buy and hold for long-term rental income, fix and flip for short-term gains, or developing new residential units. Investors must carefully analyze cash flow, vacancy rates, and potential appreciation to make informed decisions. The emotional aspect of housing can also influence market dynamics, making it distinct from purely commercial investments. Successful residential investors prioritize strong tenant relations and proactive property maintenance. Commercial real estate investing. Commercial real estate (CRE) investing involves properties used for business activities, such as office buildings, retail centers, and industrial warehouses. This sector typically offers higher potential returns than residential real estate, but often comes with greater capital requirements and complexity. Office buildings provide space for businesses, retail centers house shops and restaurants, and industrial properties are used for manufacturing, storage, and logistics. Investors in CRE often seek long-term leases with corporate tenants, which can provide stable and predictable income streams. The performance of CRE is closely tied to economic cycles, employment growth, and consumer spending. Understanding the specific needs of commercial tenants and the dynamics of local business environments is crucial. Key considerations for commercial real estate investors include lease structures, tenant creditworthiness, and market demand for specific types of commercial space. Leases are often longer and more complex than residential leases, with various clauses regarding rent escalations, operating expenses, and tenant improvements. Assessing the financial stability of potential tenants is paramount to ensure consistent rent payments. Market analysis must focus on vacancy rates, absorption rates, and new construction in the specific commercial submarket. Challenges include higher vacancy risks during economic downturns, specialized property management needs, and potentially longer holding periods for liquidity. Successful CRE investing requires a sophisticated understanding of business economics and strong negotiation skills. Diversification across different commercial property types can help mitigate risk. Industrial real estate investing. Industrial real estate encompasses properties used for manufacturing, storage, distribution, and logistics. This sector has seen significant growth, particularly driven by the rise of e-commerce and global supply chains. Key property types include warehouses, distribution centers, manufacturing facilities, and flex spaces. Warehouses and distribution centers are crucial for storing and moving goods efficiently, often located near major transportation hubs. Manufacturing facilities are specialized properties designed for industrial production, while flex spaces offer a combination of office and warehouse space, catering to diverse business needs. Investing in industrial real estate often provides stable income from long-term leases with corporate tenants. The demand for modern, efficient industrial spaces continues to be strong. Factors influencing industrial real estate investment include proximity to transportation infrastructure, ports, highways, rail, labor availability, and technological advancements in logistics. The growth of e-commerce has spurred demand for last-mile distribution centers, strategically located near urban areas. Automation and robotics are also transforming industrial spaces, requiring properties with higher clear heights, advanced loading docks, and robust power infrastructure. Investors must consider the specific needs of industrial tenants, such as specialized equipment requirements and security concerns. Challenges include environmental regulations, higher construction costs for specialized facilities, and potential obsolescence if technology rapidly changes. Successful industrial investing requires a keen understanding of supply chain dynamics and future technological trends. This sector offers diversification benefits and resilience during economic shifts. Retail real estate investing. Retail real estate encompasses properties where goods and services are sold to consumers, ranging from small storefronts to large shopping malls and power centers. This sector is highly sensitive to consumer spending habits, economic conditions, and the evolving landscape of retail, particularly the rise of e-commerce. Traditional retail properties include strip malls, regional malls, and standalone stores. Newer formats like mixed-use developments, which combine retail with residential or office spaces, are gaining popularity. Successful retail investing hinges on understanding consumer demographics, traffic patterns, and the ability of tenants to attract customers. Location, visibility, and accessibility are paramount for retail success, directly impacting tenant sales and property value. The challenges in retail real estate investing have intensified with the shift towards online shopping, leading to increased vacancies in some traditional retail formats. Investors must adapt by focusing on experiential retail, essential services, and properties that complement e-commerce, such as showrooms or click-and-collect locations. Tenant mix is crucial. A diverse and complementary set of retailers can create synergy and attract more foot traffic. Lease structures often include base rent plus a percentage of sales, aligning landlord and tenant interests. Redevelopment and repositioning of older retail assets into mixed-use or entertainment-focused centers are also common strategies. Understanding local market demographics, consumer preferences, and the competitive landscape is vital for identifying resilient retail investment opportunities. The ability to innovate and adapt to changing consumer behavior is key for long-term success in this dynamic sector. Real estate investment trusts, REITs. Real estate investment trusts, REITs, are companies that own, operate, or finance income-producing real estate across a range of property sectors. They are often compared to mutual funds, but for real estate, allowing individual investors to buy shares in commercial real estate portfolios. REITs are publicly traded on major stock exchanges, offering liquidity and diversification benefits that direct property ownership typically lacks. They are legally required to distribute at least 90% of their taxable income to shareholders annually in the form of dividends, making them attractive for income-focused investors. This structure avoids corporate income tax, as long as the distribution requirement is met. Investing in REITs provides exposure to large-scale real estate projects without the complexities of direct management. There are various types of REITs, specializing in different property sectors such as residential, retail, office, industrial, healthcare, and data centers. Equity REITs own and operate income-producing real estate, generating revenue primarily from rents. Mortgage REITs, MREITs, provide financing for income-producing real estate by purchasing or originating mortgages and mortgage-backed securities, earning income from the interest on these investments. Hybrid REITs combine strategies of both equity and mortgage REITs. Investors should research the specific sector a REIT operates in, its management team, and its dividend history. While REITs offer diversification and liquidity, they are subject to market risks, interest rate fluctuations, and the performance of the underlying real estate assets. They provide a convenient way to add real estate to a diversified investment portfolio. Real estate development. Real estate development involves a comprehensive process of enhancing existing properties or constructing new ones, from raw land to finished projects. This complex endeavor typically includes land acquisition, planning, financing, construction, and marketing. Developers identify opportunities, assess feasibility, and secure necessary permits and approvals from local authorities. The planning phase involves architectural design, engineering, and environmental studies to ensure the project meets regulatory standards and market demand. Development projects can range from single-family homes to large-scale mixed-use communities. It is a high-risk, high-reward undertaking that requires significant capital, expertise, and a long-term vision. Successful development can transform communities and generate substantial profits. Financing development projects often involves a combination of equity and debt, with construction loans being a common form of debt. Managing the construction phase requires careful oversight of budgets, timelines, and quality control. Marketing and sales or leasing efforts begin well before completion to secure tenants or buyers. Post-completion, developers may choose to sell the asset or hold it for long-term income. Challenges in real estate development include navigating complex regulations, managing construction costs and delays, and responding to market shifts. Environmental impact assessments, community engagement, and risk mitigation strategies are integral to successful development. A keen understanding of urban planning, market trends, and project management is essential for developers to bring their visions to fruition and create valuable assets. Risk management in real estate. Real estate investments, while potentially lucrative, are subject to various risks that must be carefully managed to protect capital and ensure profitability. Market risk, stemming from economic downturns, interest rate fluctuations, or changes in supply and demand, can impact property values and rental income. Liquidity risk refers to the difficulty of quickly converting a real estate asset into cash without a significant loss in value, as transactions can be lengthy. Credit risk arises from the possibility of tenants defaulting on rent or borrowers failing to repay loans. Understanding and identifying these risks is the first step towards developing effective mitigation strategies. Proactive risk assessment is a cornerstone of successful real estate investment. Operational risks include issues related to property management, maintenance, and tenant relations. Environmental risks, such as contamination or natural disasters, can lead to significant liabilities and repair costs. Legal and regulatory risks involve changes in zoning laws, property taxes, or landlord-tenant regulations. To mitigate these risks, investors employ various strategies. Diversification across different property types or geographic locations reduces market exposure. Thorough due diligence minimizes unforeseen issues. Obtaining adequate insurance coverage protects against physical damage and liability. Establishing contingency funds for unexpected expenses and maintaining strong tenant screening processes are also vital. Regular market monitoring and professional property management further enhance risk control, ensuring investments remain secure and profitable over time. Tax implications of investments. Understanding the tax implications of real estate investments is crucial for maximizing after-tax returns and ensuring compliance with tax laws. Real estate offers several unique tax advantages, including depreciation, which allows investors to deduct a portion of the property's value over its useful life, even if the property is appreciating. This non-cash expense can significantly reduce taxable income. Other deductions include mortgage interest, property taxes, operating expenses, and insurance premiums. Capital gains taxes apply when a property is sold for a profit, but these can often be deferred through strategies like 1031 exchanges, allowing investors to reinvest sale proceeds into a similar property without immediate tax liability. Proper tax planning is essential for optimizing these benefits. However, investors must also be aware of potential tax liabilities such as recapture of depreciation upon sale, which taxes previously deducted depreciation at ordinary income rates. Passive activity loss (PAL) rules can limit the deductibility of losses from rental activities, though exceptions exist for real estate professionals. State and local property taxes are ongoing expenses that vary widely by jurisdiction and can significantly impact cash flow. Inheritance and gift taxes may also apply to real estate assets. Consulting with a qualified tax advisor is highly recommended to navigate the complexities of real estate taxation, structure investments efficiently, and ensure compliance with ever-changing tax codes. Strategic tax planning can significantly enhance the overall profitability of a real estate portfolio over the long term. Exit strategies for investors. Having a well-defined exit strategy is as important as the initial acquisition strategy in real estate investing. An exit strategy outlines how an investor plans to dispose of a property to realize profits or minimize losses. One common strategy is outright sale, where the property is sold on the open market, typically after a period of appreciation or when market conditions are favorable. This allows investors to cash out their equity and reinvest elsewhere. Another option is a 1031 exchange, which allows investors to defer capital gains taxes by reinvesting the proceeds from a sale into a like-kind property, providing a powerful tool for wealth accumulation. Deciding on the optimal time to sell involves careful consideration of market cycles, property performance, and personal financial goals. Other exit strategies include refinancing the property to pull out equity, which can be used for other investments while retaining ownership of the original asset. This is particularly effective when interest rates are low and the property has appreciated significantly. Passing the property down to heirs is another long-term strategy, offering potential estate planning benefits. Converting a rental property into a primary residence or vice versa can also be an exit strategy, depending on personal circumstances. For multifamily or commercial properties, selling the asset to an institutional investor or a larger portfolio buyer might be an option. Each exit strategy has its own financial and tax implications, requiring careful planning and professional advice. A clear exit plan provides flexibility and helps investors achieve their financial objectives, adapting to changing market conditions and personal needs. Global real estate opportunities. Investing in global real estate offers significant opportunities for diversification, higher returns, and exposure to different economic cycles and growth markets. While domestic markets may face specific challenges, international markets can provide alternative avenues for growth. Emerging markets, for instance, often present higher growth potential due to rapid urbanization, expanding middle classes, and infrastructure development. Developed markets, on the other hand, offer stability, strong legal frameworks, and mature investment environments. Understanding the unique economic, political, and cultural landscapes of different countries is paramount before venturing into international real estate. This global perspective can unlock new investment horizons and mitigate risks associated with over-reliance on a single market. However, global real estate investing also comes with its own set of complexities and risks. Currency fluctuations can impact returns, as can varying legal systems, property rights, and taxation policies. Political instability, economic sanctions, and cultural differences in business practices also pose significant challenges. Investors must conduct extensive due diligence, often requiring local expertise and partnerships to navigate these complexities effectively. Investing through global REITs or real estate funds can provide a more accessible way to gain international exposure without direct ownership and management burdens. Careful research, professional guidance, and a clear understanding of international market dynamics are essential for successful global real estate investments. The potential rewards often justify the additional effort in managing these unique risks. Sustainable real estate investing. Sustainable real estate investing, also known as green or ESG, environmental, social, and governance investing, focuses on properties that are environmentally responsible, socially beneficial, and governed ethically. This approach is gaining significant traction due to increasing awareness of climate change, regulatory pressures, and growing demand from tenants and investors for sustainable properties. Green buildings incorporate features like energy-efficient systems, renewable energy sources, water conservation technologies, and sustainable materials. These properties often result in lower operating costs, reduced environmental impact, and enhanced tenant well-being. Investing in sustainable real estate aligns financial goals with broader societal and environmental objectives, offering long-term value and resilience. The benefits of sustainable real estate extend beyond environmental impact, encompassing financial advantages such as higher occupancy rates, increased rental income, and greater property value. Green certifications like LEED or BREEAM can enhance a property's marketability and attract environmentally conscious tenants. Social aspects include creating healthy and inclusive communities, while governance focuses on transparent and ethical business practices. Challenges include higher upfront construction costs for green features, though these are often offset by long-term operational savings and potential incentives. Investors must conduct thorough due diligence to verify sustainability claims and assess the true impact of green initiatives. Integrating ESG factors into investment decisions not only contributes to a better planet, but also positions portfolios for future growth and reduced risk in a rapidly evolving market. This approach represents a forward-thinking strategy for modern real estate investors. Technology in real estate, PropTech. PropTech, or property technology, refers to the application of technology and digitalization to the real estate industry. This rapidly evolving sector is transforming how properties are bought, sold, managed, and financed. Key areas of PropTech include smart home technologies, virtual reality, VR, and augmented reality, AR, for property tours, blockchain for secure transactions, and artificial intelligence, AI, for market analysis and predictive analytics. Smart home devices enhance tenant experience and energy efficiency, while VR/AR tools offer immersive property viewings, expanding reach and saving time. These innovations are streamlining processes, improving transparency, and creating new opportunities for investors and consumers alike. Embracing PropTech is becoming essential for staying competitive in the modern real estate market. Blockchain technology is being explored for secure and transparent property transactions, potentially reducing fraud and speeding up closing processes. AI and machine learning algorithms are used to analyze vast amounts of market data, identify investment trends, and predict property values with greater accuracy. Property management software automates tasks like rent collection, maintenance requests, and tenant communication, increasing efficiency. Real estate crowdfunding platforms leverage technology to democratize access to investments, allowing smaller investors to participate in larger projects. While PropTech offers immense potential, challenges include data security concerns, the need for interoperability between different platforms, and the initial cost of adoption. Investors who strategically integrate PropTech solutions can gain a significant competitive advantage, optimize operations, and unlock new investment opportunities, driving innovation across the entire real estate value chain. Building an investment portfolio. Building a diversified real estate investment portfolio is a strategic approach to mitigate risk and optimize returns. Diversification involves spreading investments across different property types: residential, commercial, industrial, geographic locations, and investment strategies, buy and hold, development, REITs. This reduces the impact of a downturn in any single market or sector. For example, if the residential market in one city slows, a diversified portfolio might still perform well due to strong commercial performance in another region or stable income from a REIT. A well-constructed portfolio balances risk and reward, aligning with an investor's long-term financial goals and risk tolerance. It is not about avoiding all risk, but about managing and spreading it effectively. The process of building a portfolio involves setting clear investment objectives, conducting thorough market research, and continuously monitoring and rebalancing assets. Objectives might include income generation, capital appreciation, or a combination of both. Research helps identify suitable properties and markets that align with these objectives. Regular review of the portfolio's performance against market benchmarks and personal goals is crucial for making informed adjustments. Rebalancing might involve selling underperforming assets, acquiring new properties, or adjusting the allocation between direct and indirect investments. Professional advice from financial planners and real estate experts can be invaluable in constructing and managing a robust portfolio. A disciplined approach to portfolio construction and management is key to achieving sustained success in real estate investing, ensuring long-term wealth creation and financial stability. Future trends and outlook. The real estate investment landscape is continuously evolving, shaped by emerging trends and global shifts. Key future trends include the increasing demand for sustainable and ESG-compliant properties, driven by environmental concerns and investor preferences. The continued growth of PropTech will further revolutionize property management, transactions, and market analysis, making processes more efficient and transparent. Demographic shifts, such as urbanization and the aging population, will influence demand for specific property types, like senior living facilities or affordable housing in urban centers. Understanding these macro trends is crucial for positioning investments for future success and identifying new opportunities. Adapting to these changes will be vital for long-term profitability. Economic globalization will continue to open up new international investment opportunities, though accompanied by increased geopolitical risks and currency volatility. The rise of flexible work arrangements will reshape demand for office spaces, potentially leading to more flexible office solutions or a greater emphasis on residential properties with dedicated home office spaces. Data analytics and artificial intelligence will play an even larger role in informing investment decisions, providing deeper insights into market behavior and property performance. Investors must remain agile, continuously educate themselves, and embrace innovation to thrive in this dynamic environment. The future of real estate investing will be characterized by greater technological integration, a stronger focus on sustainability, and a more interconnected global market, requiring a forward-thinking and adaptable approach.